Hey traders, Jim here. In this video, we're going to talk about how to sell cash secured puts for income. It's a straightforward guide to one of the most popular options income strategies explained in under 10 minutes. I'll do my best. Brought to you by OptiTrades. Come on over to www.optytrades.com. Check out our software. First, let's start with our disclaimer. This presentation is for educational and informational purposes only. It does not constitute financial, investment, or legal advice, and options trading involves significant risk and is not suitable for all investors. You may lose some or all of your money that you invest, and past performance is not indicative of future results. Always do your own research and consult a licensed financial advisor before making any investment decisions. We're an educational resource, and we do not manage client funds or provide personalized investment advice. So what is a put option? Before we sell one, let's understand what a put option actually is. A put option gives the buyer the right, but not the obligation, to sell 100 shares of a stock at a specific price. This is called the strike price. Before a certain date. This is called the expiration date. From the buyer's perspective, the buyer pays a premium for protection. Profits if the stock drops below the strike price. The seller's perspective, that's you collect that premium as income immediately, and you agree to buy shares at the strike price if assigned. This is the strategy we're learning today. What makes it cash secured? The word cash secured is key, and it's what makes the strategy safer and more accessible than many other options plays. Here's the idea. When you sell a put, you're promising to potentially buy 100 shares at the strike price. To back up that promise, your broker requires you to hold the full cash amount in your account. Set aside cash. You reserve enough cash to buy at least 100 shares at the strike price. Your broker holds this as collateral. Collect the premium. You immediately receive cash, the premium, just for entering the trade, no waiting required. You have a defined risk. Your maximum loss is capped at the cost of buying shares, minus the premium you already collected. So how does it work? Here's a simple example. Let's say stock XYZ is trading at $50 a share. You've already done your research on the stock. You've been over to OptiTrades. You've looked at the stock's financials, the 52-week charting, and you'd be happy to own it at $50 a share, but even more happy at $45. Here's how a cash secured put might look. 1. Choose your strike price. You sell the 45 put expiring in 30 days. XYZ is at $50, so $45 is what we call out of the money, or OTM. Step 2, collect a premium. You receive $1.50 per share. That's $150 cash deposited into your account immediately. Step 3, wait for expiration. You set aside $4,500 for every one contract because the strike price is $45. That's 100 shares times 45 as collateral while the trade runs. Step 4, outcome. XYZ stays above $45, put expires worthless, you keep the $150. If XYZ falls below 45, you buy 100 shares at $45. You still keep your premium, but you own the shares now effectively at $43.50 after your premium is factored in. The two possible outcomes. When your cash secured put expires, one of two things happen. Both outcomes can be favorable if you've chosen wisely. Outcome 1. Put expires worthless, stock stays above your strike price, the put expires with no value. You keep the full premium as profit. Your cash is released, you can sell another put and do it all over again. Outcome 2. You get assigned. The stock falls below your strike price, you are obligated to buy 100 shares at the strike. Your effective cost is the strike minus the premium collected. You now own stock you are already willing to buy at a discount. Key terms every trader should know. Options come with their own vocabulary. Here are some of the most important terms you'll encounter when selling cash secured puts. Strike price. That's the agreed upon price at which you'd buy the stock if assigned. Always choose a strike you'd genuinely be happy owning the shares at. Premium. The cash you collect up front for selling the put. This is your income and you keep it no matter what happens. Expiration date, the date the option contract ends. Most traders start with the 30 to 45 day expiration. We also call that the 30 to 45 DTE, days to expiration. Out of the money, OTM. When the strike price is below the current stock price, selling OTM puts is lower risk and a great starting point. Side note, if it's ITM, that's in the money. That means that the stock has dropped below your strike price and you're probably going to be put. Assignment, when the put buyer exercises their right and you're required to purchase the shares at that strike price. How to choose the right stock and strike. Not every stock is a good candidate for this strategy. Here's a checklist for picking smart trades. Stocks you'd actually own. Only sell puts on companies you'd be comfortable owning if assigned. Never use this strategy on a stock you'd hate to hold. Liquid options markets. Look for stocks with high options volume and tight bid-ask spreads. Poor liquidity means worse prices and harder exits. 30 to 45 days to expiration. This is the sweet spot. It captures the fastest rate of time decay. We call that theta. Theta is our friend. Maximizing premium collected while limiting time exposure. Strike at a 30 or lower delta. A delta of 30 means roughly 30% chance of being in the money at expiration or getting assignment. Lower delta, lower risk, lower premium. Risks to understand before you start. Cash secured puts are relatively straightforward, but they're not risk-free. Understanding the risks before you trade is what separates smart investors from impulsive ones. Stocks can drop sharply. If a stock falls far below your strike, you'll be assigned shares at a price significantly higher than the market. The premium only partially offsets the loss. Your capital is tied up. Your cash is held as collateral for the duration of the trade. You cannot use it for other investments until the position closes. Opportunity cost. If the stock rockets upward, you miss out on those gains. You only collect the fixed premium no matter how high the stock climbs. Earnings and events. Avoid selling puts right before major earnings announcements or news events. Volatility can cause sudden, dramatic stock moves. Step-by-step placing your first trade. Ready to try it? Here's exactly how to execute a cash secured put on most brokerage platforms from start to finish. Get approved. Obtain level 1 options permission. Fund an account. Deposit cash to cover at least 100 shares of what you're going to trade. Choose a stock. Pick a stock you'd want to own. Select an option. Pick strike and 30 to 45 days to expiration and a delta of 30 or less. Key takeaways and next steps. You know everything you need to understand the cash secured put strategy. Here's a quick recap and where to go from here. Sell puts only on stocks you'd love to own. Your strike price should feel like a bargain price, not a consolation prize. Collect premium immediately as income. The cash hits your account the moment the trade opens, win or lose on the outcome. Target 30 to 45 days to expiration and 30 delta strikes. This sweet spot balances premium income with a high probability of expiring worthless. Close early at early profit. Many pros close their positions when they've captured most of the max premium, locking in gains and freeing up capital faster. Visit OptiTrades for more strategies. Explore the options, income strategies, tools, and education at www.optitrades.com. Have a great day.